Now, Jim is the chief global strategist at West Shore Funds and author of the best-selling book, The Death of Money. Now, I first asked Jim for his take on the juxtaposition between the decline in oil collapse and collapse in the ruble, and the commentators that seem so bullish on the economy. Here's what he had to say.
We had a near meltdown of the international monetary system in 1998. We had another one in 2008. You know, I'm a big baseball fan. I think 3 strikes, you're out. If we have another financial meltdown, we may not recover so easily the next time. So I agree with the idea that there are a lot of unforeseen consequences. Look, oil has come down, 40% just in a matter of months. That's one of the 3 largest, fastest declines in the price of oil ever. It's a very significant loss. Now, this whole idea that puts money in consumers' pockets, sure. I'd rather pay $2 for gas than $4 for gas. And if you use 100 gallons of gas a week, that puts $200 in your pocket. But first of all, it doesn't mean consumers will spend it. They might use it to pay off their kids' student loans or their own student loans. That's the first problem. It doesn't all go into consumption. But the second problem is it's a zero-sum game. For every winner, there's a loser. There are trillions of dollars of junk bonds issued by oil exploration companies and oil development companies since 2009 out in the marketplace that were priced on the assumption that oil would be between $80 and $150 a barrel. But with oil at 60 or even lower, some percentage of those bonds are going to default. Where are those bonds? Well, they might be in your 401k, and that's the problem. They might be in the banks. And so those losses are going to cascade through the system, and this could easily spin out of control. So I agree that there are unforeseen consequences and hidden losses. I'm not quite so sanguine that this is all going to work out smoothly in the end.
Jim, you were at long-term capital management in 1998, so you know a thing or two about crises. Is this a crisis, Jim?
It looks like the beginning of one. I have to say, I'm very slow to say, gee, it looks like a crisis, because, I've seen big events happen and they just kind of go away and nothing bad comes of it. But this does have that familiar feel to it. In 1998, the last time Russia melted down, it ended up in my lap. I was general counsel of long-term capital management, and we were caught in the eye of the storm, had to be rescued by the Fed sponsored a Wall Street bailout, and I negotiated that bailout. So for me, this is sort of deja vu all over again. But, remember, that crisis, which came to a head in September of 1998, actually started in Thailand in June of 1997. And then it spread to Indonesia, then Korea, then Russia. Then everyone was expecting it to go to Brazil, and up popped long-term capital management, a hedge fund, not exactly a country, but I guess we sort of played that role, and then that's where the crisis crystallized. So that's an example how it can take a year or more to play out, and it pops up in unexpected places. So we're seeing a financial meltdown in oil and in the Russian ruble today, but don't be so sure you know where it's going to end up. So what happens is people just kind of run for liquidity. They say exactly that. They say, there are going to be big losses out there somewhere. May not know exactly where they are, but just get me out of stocks and bonds, get me into cash, get me into some hard assets. I'm just going to go to the sidelines. That's what starts a liquidity crisis. So let's see. I don't want to be too, kind of melodramatic, but that's how these things start, and this could be a big one.
Now, the latest decline in oil prices was precipitated by weak economic numbers out of China. So do you think China's growth rate is going to decline from here?
Well, I think China's growth rate is going to decline for a lot of reasons, sort of cause and effect. The oil is a little more to it. You have China slowing down. Oil is, supply and demand is economics 101. So demand is declining to a great extent from China because China is slowing down, but also Japan and elsewhere around the world, Europe, et cetera. And then supply is going up because of fracking technology, and OPEC is not cutting enough to support the price. Less demand, more supply, you're going to get a lower price. So that much is fairly straightforward, although, there's always a little something going on behind the scenes in terms of the geopolitics. Does Saudi Arabia want to hurt Iran because of their nuclear program? Does Saudi Arabia want to hurt Russia because of their support for Assad in Syria? I mean, there's some things going on behind the curtain. But getting back to China, their growth is slowing down anyway. First of all, their numbers are overstated. I don't mean they completely make them up. I just mean that so much of Chinese GDP is investment that's being wasted. Not all of it, but a significant percentage of it, maybe half. And so if you adjust Chinese GDP for the portion of investment that is just sort of flushed down the sewers, their actual growth is more like 4.5%, and it may slow down from there. So, look, China's slowing down. Japan hit the wall this year. I mean, they're in desperate trouble. Europe is in recession. I think the U.S. could be very close to recession. That's why I don't expect the Fed to raise interest rates in 2015. The whole world's slowing down. So you see it in oil, you see it in Russia, you see it in a lot of places.
Jim, where specifically is the risk in financial markets right now?
Well, it's hard to, it's all over the place, actually. Let me just give you a concrete example. So we see the Russian ruble, collapsing, and I saw a headline today saying Russian ruble's in trouble. Well, a currency can't be in trouble. A currency is just a currency, right? The currency is not a stock, it's not a bond, it's not a borrower, it's just a currency. So where is the problem? Well, if you look at the Russian government, they don't have that much external dollar-denominated debt. And they have enough reserves to more than cover their external debt. So the government's not in trouble. Now, corporations, sure, some of them have dollar-denominated debt, but a lot of them earn dollars. So, a company like Rosneft, they may have borrowed in dollars, but they sell oil and they get paid in dollars, so they may be okay also. So the real loser is, if there's a Russian company, for example, that borrowed in dollars but makes money in rubles because they sell, maybe a large auto dealer in Moscow, they got to borrow dollars to buy their inventory and they sell for rubles in Russia. Those types of companies could be in trouble. But where are the bonds? Those bonds are in European banks and U.S. 401ks. So, there's some Americans kind of rooting for all this Russian distress. And I think geopolitically, the White House is trying to, in effect, use financial warfare to attack Russia because of actions in the Ukraine. But be careful what you wish for, because if there's Russian dollars-denominated corporate debt, it could be in U.S. 401ks. So this is a good example of the interconnectedness of the world today. So I guess my advice to investors would be, look in your 401ks, see what's there, and also be ready for unintended consequences and be careful what you wish for.
Jim, why did the rate hike in Russia fail to stem the tide?
Well, the currency is still convertible for the time being. The Russian, one of the central bank officials said Russia has no intention to put on currency controls. That remains to be seen. I mean, they may have to, although I actually don't think they will, at least in the short run. But, we kind of watch that. It's basically kind of a run on the bank, and people with rubles want to get dollars because they think it's going down more. So it feeds on itself to some extent. Now, the whole idea of the rate hike increase, the rate increase is to say, well, no, leave your money in rubles, we'll pay you a lot of money. We'll see how it plays out. They may have to raise it again. Look, 17% interest rates in Russia. In 1998, the rates were 100%. In 1980, U.S. rates were 20%. So 17% is not unheard of. And I do think that Russia has a competent set of central bank officials, and they're going to stay on top of the situation. It's, when you have a run on the bank, you can either shut your doors or raise rates. So I think raising rates is a smart policy move.
That was Jim Rickards, Chief Global Strategist at West Shore Funds and author of The Death of Money. Time now for today's Big Deal.